So welcome to chapter 5. You've made it through the first unit. You learned a lot of information, kind of a big broad overview of accounting. So if you're feeling a little overwhelmed, just know that that is completely and totally normal. We're going to go back starting now here with chapter 5 and go over things that we've learned before that we kind of briefly touched on in those first 4 chapters. And we're going to go into them in some greater detail and then learn some new information as well. So from here on out, you'll start with a foundation of knowledge. You know something about what we're talking about, and that makes it a little bit easier going forward. So in this chapter, we're going to be a merchandiser and we're going to start selling inventory. So a merchandiser is a business that sells a good, that sells a physical product as opposed to just providing a service. So when we sell a good, that good that we're selling is called merchandise inventory. Inventory is an asset. Specifically, it is a current asset. Now, just to remind us, remember all assets are recorded at their historical cost. So when we buy the inventory, we're going to record it in our books at how much we paid for it. Now, we'll talk about this a lot more in Objective 2, but typically when we buy the inventory, we're going to buy it on account, meaning we'll have an account payable. We'll have a deal set up with our suppliers where we say, hey, send us a bill, we'll pay you later, and that's no problem. When we sell the inventory, depending on who our customers are, we may sell it for cash or we may sell it on account. On account sales typically happen if our customers are other businesses. So if our customer's another business, we may have worked a deal with them where we'll say, yeah, we'll send you a bill, you can pay us later. Now, you and I don't really get to do that usually. When we go into Target or Walmart and we fill up our cart, we have to pay for it before we leave. Now, even if you use a credit card, that's considered a cash sale to the Target or Walmart, to the merchandiser. But we'll talk about that later also. So as we get into this again, more specifically in Objective 2, we're going to talk a lot about accounts payable and accounts receivable, and then we collect the cash from the customers that we then turn around to use to pay our accounts payable. Now, some more new information or some new accounts that we have. When we are a seller of goods, we have an account called sales revenue as opposed to service revenue. So service revenue is where we would record the money that we earned from providing a service, whereas sales revenue is the money that we earn from selling a good. If we're a company that does both, then we will have both revenue accounts and we'll credit service revenue or sales revenue depending on what it is we're selling at the time. We also have a new expense account called cost of goods sold. So cost of goods sold, again, remember this is an expense account. An expense account, remember an expense is an asset that is used up in the production of revenue. So cost of goods sold is the inventory that we used up or sold in order to generate revenue. So we'll talk about that again a little bit. Remember, all expenses have a normal debit balance. So we're going to see on our income statement we have a new total or subtotal called gross profit. So net sales revenue, I'll address the net part later, is our selling price. So let's just go with an example. Let's say we're selling t-shirts. And let's say that we sell those t-shirts for $10. So our sales revenue would be $10, but we had to buy the t-shirts before we could sell them. So we paid, let's say, $4 for those t-shirts. So every time I sell a t-shirt, I'm going to record revenue of $10, and then I'm going to also have this expense of $4. So that means that my gross profit is $6. That's the profit that I earned just from selling the t-shirt. Now that's not overall profit because I've still got to pay all my other operating expenses out of that. But it's a measure of profit. You'll sometimes hear gross profit also called gross margin. Now, for those of you that have taken economics, you talk about a lot of margins in economics. Gross margin and the margins you talk about in economics are not the same thing. They're very different, so don't let that confuse you. I tend to always call it gross profit. And then operating expenses, we'll talk about these more later in the chapter, but those are all of those sort of normal expenses that you would incur to run your business on a day-to-day basis. So rent expense, salary expense, insurance expense, utilities expense, all of those kinds of normal day-to-day expenses. So we're going to come back and address this part a lot more in the last objective that we cover. So I'm just going to briefly touch this now. But our income statement for a merchandiser is going to look slightly different than it did for a service provider. So on the left, we were a service company, and we use what's called a single step income statement. So you see our service revenue, then we have all of our operating expenses, and we said we're going to put parentheses around these total expenses because we're subtracting them. So revenue minus total operating expenses gave us net income. Remember, the columns in financial statements do not mean debit and credit. They mean individual amounts, and then in the first column, and then totals and subtotals in the second column. But if I'm a merchandiser, I'm going to use what's called a multi-step income statement. So I'm going to show net sales revenue, and then I'm going to subtract out that cost of goods sold expense account. So that gives me my gross profit right up front, right at the top of the income statement. Very, very important number. Then I'll list all of my expenses individually in that first column, and I'll put the total operating expenses in the second column. I'm going to put my parentheses around that as well. So now I have gross profit minus total operating expenses gives me my net income number. Now my balance sheet's going to look a little bit different as well. I have a new current asset, merchandise inventory. Remember, current assets are always listed in order of liquidity, meaning how quickly we can convert them into cash. So that means cash is always the first current asset listed, then accounts receivable second, and typically inventory comes third. So we'll see these three listed first always, and then after that it's just kind of whatever, but it's important that those three are listed first. Now, there are two different types of inventory systems that we can use. If we are an older company, or excuse me, if a long time ago everyone did use a periodic inventory system. Periodic inventory system typically is a non-computerized system. In this system, you record your sales in your records, but you don't record the decrease in inventory when you sell a good. So it's not till you get to the very end of the year, and then you have to go in and do a physical count of your inventory to determine what your ending inventory is. And then you'll say, well, I know what my inventory was at the beginning of the year. I know how much inventory I purchased. I subtract out how much my ending inventory is, and so whatever's missing must be cost of goods sold. So under a periodic system, you have to physically count your inventory in order to determine what your cost of goods sold and ending inventory numbers are. Now, almost nobody uses a periodic inventory system anymore, so I'm not even going to teach it to you. It's covered in the appendix to Chapter 5 if you're just really interested, but most people don't use it. Most companies have gone to a computerized inventory system, which means we use a perpetual inventory system. Under a perpetual inventory system, we are always going to keep a running total of inventory and cost of goods sold. What this means for us is that every time we sell something, we have to make two journal entries. So the first entry is to record the sale. This is the same entry that we learned way back in Chapter 2. Remember, sales revenue is a revenue account, which means it is always, always, always credited. So I'm going to credit, in this case, sales revenue as opposed to service revenue. And I'll debit either cash or accounts receivable, depending on how the customer paid me. Now, this journal entry is for the selling price. So this would be, if we go back to our t-shirt example, for $10. So I'll debit cash or accounts receivable, credit sales revenue for $10. This is again for the selling price. Even though I got a touchscreen computer, I still don't have very good handwriting. Now, under a perpetual inventory system, we're going to do a second entry every time we sell a good because we want our inventory account to always be updated. So if I sold a t-shirt, that means I have one less t-shirt. So I need to decrease my inventory account. Now remember, inventory is an asset, and assets have a normal debit balance. So to decrease inventory to show that I have fewer t-shirts now than I did before, I would want to credit inventory. Now, since all assets are recorded at their historical cost, I want to credit this inventory at what it cost me, which we said was $4. So I'm going to credit inventory to show, hey, look, I have one fewer t-shirts. Now, because I credited inventory, I used up this asset in order to generate revenue, I have to debit an expense. And that expense account is that cost of goods sold. Remember, expenses are always debited. So I'm going to debit cost of goods sold at the cost of the good that I sold, which was $4. So this entry is always for what it cost me, so my cost. And the first entry is always for the selling price. So every time I make a sale, I'm going to do these exact same two entries. In fact, nothing ever changes other than the amounts, obviously, except I have to determine, did the customer pay cash or did they buy on account? That's the only thing that's going to change, and then of course the amounts will change.